All right, well, welcome out to the BluSky Trading Lab. We are doing week 3 of swing trading conversation. And the first week we did 2 weeks ago now, we just talked in general about the mindset of the swing trader, talked about the basic technical analysis that people are looking at when they're talking about swing trading. We also talked a little bit about set method and how to kind of look at stop loss entry targeting. Last week, we kind of worked on entry and stop technique on swing trading, and we kind of left it off right when we started getting into targeting techniques. And when it comes to targeting techniques, I want to ask you guys a question. How comfortable are you with targeting techniques as a trader? Scale at 0 to 10. 0, you have no clue how to target. 10, you feel very good about targeting techniques. How well do you understand that concept? Nacho -10? That's aggressive, brother. That's aggressive. Link 3, Woj 6. RQ like a 6, Derek a 6. As a day trader, would you agree that as a day trader, the targeting techniques are level to level type scenarios where you're constantly targeting another level of support or resistance? Would you agree that's kind of how we navigate the targeting techniques as a day trader? That's not the case as a swing trader, guys. Not at all. In fact, swing traders don't really talk about level to level because level to level is you're trading inside some degree of pattern. You're trading in some degree of neutrality, a neutral condition. When you're a swing trader, you're targeting above those things. You're targeting future expectation. And to understand how to target future expectation, you kind of have an understanding of the behaviors of the past. Um, but as a day trader, that's how you do it. You go level to level to level to level. Well, as a swing trader, we look beyond the level because we're not just trying to get it to go to where it was. We're trying to think about where it's going to go in the future. And so targeting techniques as a swing trader is going to be different than that as a day trader. Day trading is a little bit unique. It doesn't mean there's not commonality. There is absolutely commonality, but there is some key differences, and we'll get into that here in a second. Now, as a swing trader, once again, just to kind of review where we have been here in this conversation, we use the set method philosophy as a swing trader, where we identify our trend, we identify the pattern, we identify support and resistance, and then we prep the trade around those levels. We identify our entry, we identify our stop loss, we identify not one target, we identify two targets. And we always have to have at least a 1-to-1 reward to risk ratio from our entry to T1, and we have to have a minimum of a 2-to-1 reward to risk ratio from our entry to T2. So if I'm prepping a trade and I love the pattern, I love the trend, I love the stock, but I only get zero point 0.9 return for one risk, is that a good trade? Yes or no? Is that a good trade? You love the stock, you love the pattern, you love the levels, but you just can't inch out the reward to risk ratio. What do you guys think? Nacho says no. What's everybody else think? No, of course not, guys. Of course not. You got to get that minimum of 2-to-1 at your ultimate target. Once again, 1-to-1 at target number one, 2-to-1 at target number two. And so when we were talking about entry last week, we talked about specific rules that you could apply, looking at using the ATR as a gauge to put your order in above the level that you're looking to get into, above the high of the candle that you're looking to get into, using the ATR to customize that rule. Does anybody remember what the specific rule that we created last week for entry on a swing trade? Does anybody remember the specific rule? 10% above, right? 5 to 10%, Woj. So 5 to 10% above the level where you're looking to enter. And so you identify your level that you're willing to enter, and then you add a 5 to 10% of the ATR. Now, the reason we use ATRs on that is to customize our order to fit the personality of the stock. See, as a swing trader, ladies and gentlemen, we might talk about all of these things through the technical lens, but there's a tremendous amount of behavioral analysis that goes into technical analysis. And we want to make sure that when we're going in through our entry and our stop loss technique specifically, we want to make sure that we're using the personality of the stock because it doesn't make sense to put a 1 cent rule on a stock that moves $3 a day. It doesn't make any sense to put a 10-cent stop loss on a stock that moves $10 a day. I had a trader one time call me up. He was a student of mine and he said, "Matt, I found the best trade ever. It's a 100 to 1 reward to risk ratio." Now, in your estimation, is there any swing trade that has ever existed if you're doing it properly that has a 100 to 1 reward to risk ratio? Does that mathematically exist? Yes or no? The answer is no. It doesn't. Not a chance. Not a chance. Not a chance. He put a 10-cent stop on a $500 stock. Now, if you put a 10-cent stop loss on a $500 stock, what's guaranteed to happen? Like, guaranteed to happen. All you're going to do is get stopped out. That's it. You're just going to get stopped out because you're not matching the personality of that stock to your rule. It's about understanding that personality of that stock. How far does that stock move from the high of the day to the low of the day over the last 14 candles? That's the ATR. And so the ATR allows us to customize our rules to fit the personality of the stock itself. And so for entry, most of the time when you're looking to enter into a stock, you're looking to enter into that stock at 5 to 10% of the ATR above the high. So if I'm looking at a stock, for example, let's go with Bridge Bio here. When I'm looking at this stock here, the first thing that I have to identify is where my entry is. Now, all the prep that we do here, we do on the daily chart. When you're identifying trend patterns, support and resistance, you're all doing that on the daily chart, not the intraday time frame. When we go down to the intraday time frame is to kind of pinpoint where we truly do want that entry, to pinpoint really, is that a proper stop loss placement, for example. And so for me here, the ultimate question is this wick at the top on BBIO, does this wick at the top, does it represent a good entry to get into a swing trade? And so by the way, I'm already in this trade. So just to be fully, I got into this trade earlier today when it did go above yesterday's high. If you're prepping it today, you'd be looking at today's high. And so when I got into this trade, I got into this trade with an order right above the pivot candle high. You see the pivot candle here. This is the confirmation candle here. Once you get confirmation, right there, once you get that order above that high, based on 5% of the ATR, 10% of the ATR, you get triggered into it as it's going up. If you were looking at it with fresh eyes, you would be looking at that high of the day and talking about something very similar. But the point is, you don't just use a random dollar figure. You don't do that in the market because 10 cents to Bridge Bio is a little bit different than 10 cents on Tesla that has a tendency to move very, very, very aggressively. And so how we match our the energy of the stock in our rules is because guys, as a day trader, you're just getting in and reading the price that moment, that day. Most swing traders I know, are they putting in their orders during the market session or are they putting in their orders in the overnight session? You guys tell me. I know a lot of swing traders. The majority of them, are they putting in orders after the market closes or during the market session? Nope, Nacho. I would say upwards of 80 to 90% of the swing traders I know put in their orders after the market closes. Yeah, they're using daily price action. They don't live on that 5 minute chart the same way that day traders do. And so it doesn't mean you have to. I certainly don't. I certainly like to put in my orders during the market session as well. But guys, there's a lot of traders that also have a job during the day. There's a lot of traders out there that also have responsibilities during the day. There's a lot of traders out there that can't sit in front of the market every single hour of every single day, but they still want to execute their trading systems. And to do so, they customize orders. They use ATRs above the daily high to get triggered into the position. They use the ATR, once again, 25% of the ATR underneath the support level for a stop loss. And remember, the ultimate methodology of the set method stands for set it and forget it. They allow their orders to do the work, not them making decisions during a live market. Does that make sense, everybody? It can be done either way, but for the most part, if you are not for the most part, if you are putting in orders as a swing trader in during the overnight session, you're going to want to use ATR buffers. There is no doubt about that. Now, one thing we did not get into last week was targeting methodology. And the reason we didn't get into targeting methodology is, quite frankly, it's hard to teach the basics of swing trading in a 2 hour session. And that's what we've spent over the last couple weeks. And so we decided last week to really kind of focus this session today on targeting methodology. Now, targeting methodology as a swing trader is going to be a little bit different than once again, what we use as day traders. As day traders, you guys talk a lot about orbs and VWAPs and levels to levels and all of that jazz. That language does not exist for a swing trader at all. That is a unique day trading language. It does not exist for swing traders. It does not exist for position traders. It does not exist for investors. That's not how they look at it. That's how people that look at very low time frames in the market look at. By the way, in history, are there more swing and position traders or day traders? What do you guys think? Just off the top of your head, is there more day traders and scalpers, or is there more swing traders and position traders? It's not close, guys. There is far more swing traders and position traders out there than there is day traders. And so it's just, and my whole point in that is they're both fantastic, but they are uniquely different in certain regards. Once again, the utilization of an ATR to help customize entry and stop losses, that's certainly one of them. But targeting techniques is another big difference when it comes to the day trader versus the swing trader out there. Swing traders, once again, will anchor a lot on the personality of the patterns that develop within a trend to understand how far something can move. It's based a lot on behavioral analysis. How many of you right now think in technical terms through behavioral analysis? And how many of you don't even know what I just said? Once again, when you read a chart, do you just read the pure price action, or do you also think about the behavioral analysis that creates the price action? I don't know what that gift means, RQ. I'm going to need a different answer than that if you want to participate on it. It's behavioral. It's all behavioral. Every aspect of that is behavioral. And so when you're thinking about targeting techniques, I want you to think about the people, the institutions, the investors that also are looking at that same thing. Okay, because it's not just you there. I want to understand the why behind price action, not just the price action itself, but the question of the why does that exist? The why does it behave that way? The why are we seeing consistency? The why are we seeing volatility? All of that goes to behavioral analysis. Now, as a swing trader, we use similar techniques such as Fibonacci analysis and whatnot. I'm not going to go into too much detail on that here today. The targeting technique that I really want to focus on here today, because it fundamentally changed the way I saw targeting when I learned how to do potential average yield. My mentor, Jeff Crystal, is the one who taught me how to do potential average yield. Potential average yield stands for pay ranges, is what it stands for. Potential average yield is is a look at the trend, the patterns within a trend, and to look at the consistency of the behavioral analysis within that trend. How far does a stock move on a breakout, for example? How far does a stock move from pivot to pivot analysis? When a stock breaks out, does it run 5 points? On the next breakout, does it run 5 points or does it run 20 points? If one breakout runs 5 points and another breakout runs 20 points, there's not a lot of consistency to that. And so I like to look at the consistency. And what potential average yield, the epicenter of what potential average yield is it goes back to the Wyckoff market cycle. And when we're talking about the Wyckoff market cycle, we talked about this about 4 weeks ago in the lab when I did that session on just kind of identifying what the Wyckoff market cycle is. And when we talked about that Wyckoff market cycle, we talked about there being three laws. Number one, supply and demand drive all price direction. Okay. Supply drives price down, demand drives price up. There's a causation for the supply, there's a causation for the demand. It's our job to understand that causation and how it's going to impact price. Number two, cause and effect link space building to future moves. That is a concept on yield. If the neutrality, and it's used in day trading as well, but if a neutral zone runs 10 points on a breakout, the next move should be right around 10 points. If a neutral zone runs 15 points, the next move could be a legitimate target of 15 points. That's cause and effect. Effort versus results goes to the momentum of the condition. But what we're talking about in pay ranges is the cause and effect, using historical understanding of how far something will run inside a pattern will help us understand the future expectation of how far something will run in the next pattern, because we're not trading inside the pattern here. That's a day trading conversation. We're, as swing traders, we're looking to trade outside the pattern. So when we're looking at the pattern here, when it breaks out, you have a very similar range here. That's cause and effect. Now, when it comes to utilizing potential average yield, we look at that through the lens of the patterns within a trend. Pay ranges on Wyckoff are basically analysis of how far something will move between support and resistance within neutrality. When it breaks out of neutrality, the next range will be equal to the first range according to Wyckoff. And so, or a proper expectation, for example. When it comes to this same concept, but now within a trend, that's what I'm talking about with the potential average yield, is to understand that same concept that Wyckoff was talking about inside neutrality. And now we want to apply it to a trend itself. It's similar to what I would refer to as Fibonacci analysis. I use it more than Fibonacci, to be perfectly blunt with you guys. Ever since I learned how to use potential average yield, I don't use Fibonacci extensions. Quite frankly, the only time I use personally Fibonacci extensions is to teach people Fibonacci extensions. I don't personally use them. I personally use potential average yield. I still do use Fibonacci retracements. I still wave count. I still do most things according to Elliott Wave, but I don't specifically use the extensions on Fibonacci's, because potential average yield, in my estimation, is a little bit of a more accurate technique to be perfectly blunt. But that's just my opinion. Believe me, I've had that argument with other technicians who love Fibonacci extensions and they swear to the altar of extensions. To me, I just like we all have our preferences, and I just personally like using potential average yield. Now, what potential average yield, guys, is it's a very simple methodology which can be fairly complicated when we add like candles to it. And so, what I want to do is just kind of talk about it from a philosophical perspective. And then I want to go into the market, pull up a few case studies, start prepping some stocks, start talking about where T1 would be, where T2 would be. Now, potential average yield looks at two previous patterns within the trend. And so when you're looking to make a trade, for example, and let's say we're looking to make a trade right here where the market's trying to form up support right here. Well, in looking at the average yield of the trend, what I like to do is I like to look at the previous low point to the previous high point. This move here in wave one, that sets the standard for how far something can run before it gets tired. And I want to ask you guys a question because I do think this helps people understand it. Who here, if you went outside right now and ran a mile as fast as you could, how many of you would get tired? 1 mile as fast as you could. See, our, me and RQ, we're doing the walk in RQ. We'll walk that mile. Okay. All right. Now, that's not everybody, right? Some people can run that mile really fast. Some people can't. Okay. Now, if RQ or myself, because I'm not exactly a runner either, RQ, if either one of us went out and said, we're going to go run a mile as fast as we can in under 7 minutes, and we have not proven that out at all, and both of us are sitting here going, oh man, oh, I don't want to run. Would anybody bet on us to finish that mile in less than 7 minutes? Would anybody do that? Would anybody bet on me finishing that mile in under 7 minutes? You better, because I'll die before I lose that bet. That works, RQ. We might, if we could tag team this with a baton. But if you don't have a history of doing it, is anybody going to risk their money on betting that they're going to do it now? That's the question. If you don't have a history of proving it out, nobody's going to say you're going to do it this time, right? If you have a tendency to run a half a mile before you get tired, then I would say I would bet on you to run a half a mile before you got tired. You have a tendency to show you can run that way, that much. Now, is anybody here a runner? You love to run. You just love to run. You wake up and you're like, let's go run. Let's have a spiritual cleanse in the morning and let's go for a nice little 3 mile run, a 5 mile run. Okay. Is there anybody here? Not the greatest room to ask when we're talking to a bunch of day traders. Okay. Now, let's assume Becky is the runner. Because out of all of us, I would say Becky probably has the best chance here. So, Becky, let's say Becky is a runner. She likes to go out and she runs 3 miles a day, every single day. And we have a chance to bet on Becky running the 1 mile. How many of you would bet on Becky running that 1 mile when she has a tendency to run three every single day? I would, right? That's behavioral analysis, guys. It's the history of what we as people have the ability to do. That's what behavioral analysis is. It's a study of how we behave, our human, our nature, our tendencies, our techniques, our patterns. We all have them. We all have them. And so when it comes to a stock, stocks take on the personality of the traders that trade that stock. See, guys, everybody trades futures. That trades day trades, swing trades. Everybody trades futures. Not everybody in the world even knows that BBIO is a stock, which means there is a select few people that trade BBIO over and over and over again. It's the same traders trading this stock over and over and over again. They know the personality of their stock. People seek to find stocks that fit their personality. I've met so many traders that are conservative by nature that don't want to trade anything aggressive. You know what they have a tendency to go trade? Walmart, food-based companies, utility companies. They don't want to touch that aggressive stock. They want to go get their slow burning dividend paying, trades that they can go out there and do. I usually do tell them to touch some gold there, RQ. I definitely do. I definitely do. My point is that same behavioral analysis works in running a distance as it does when you are breaking down the stock, because you do not have an unlimited amount of people coming in and out of a stock. You have these stocks live on watch list, and swing traders trade them over and over and over again until something changes. Does that make sense, everybody? And so when we're once again talking about potential average yield, what it is the study of how far something will run from the starting point to the ending point in a trend. The patterns within a trend. Does that make sense, everybody? Does that kind of bring it home to understand the concept? Okay. Now, when we look at, say, BBIO here. Okay. I'll prep this one for you guys. Okay. When I look at BBIO here, sometimes when you're using potential average yield, it's kind of like using Fibonacci, where you have some subjective elements because you have to understand where the previous wave counts were. And so, for example, when I'm looking at prepping this trade here, well, let's first talk with why I like this trade, number one. Number one, I like this trade because this is what we call the secondary pattern following an earnings release. Swing traders will not trade around this earnings event. It throws a wrench into all of the analysis. And so we don't trade through this earnings. What we allow earnings to do is to set the stage for the next move. And so we don't know if the earnings is going to gap up, gap down, gap and run. There's a lot of different gaps. By the way, would a trading lab on the types of gaps help everybody understand gaps? I'm just throwing out some technical concepts. Are you guys good on gaps, or would you like a lesson on gaps? We're good. Some need it, some don't. All right, I'll test you guys. How many standard gaps are there? How many different standard gaps are there? If you guys can get this right, I will not do a lesson. How many gaps? How many different types of gaps are there? I want to test. That's a pop quiz, guys. No, no, no. Just price gaps, not volume gaps. Just price gaps. Okay. So let me ask you another question. Should we do a lesson on gaps? Because there's five. RQ got it. I like 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 it. By the way, there's an old adage on gaps, all gaps fill. That's a lie. That's not true. Not all gaps fill. A majority of gaps fill. That is true, but not all gaps. Pop quiz hot shot. I want that gift. That's a good one, Fibs. Okay, not all gaps fill. Not all gaps fill. A majority do. All right, but my point is, okay, I don't think this gap's going to fill. That's a breakaway gap. Breakaway gaps don't fill. Um, this is an exhaustion gap. Exhaustion gaps do fill. There's different tendencies going into each gap. Now, my point is when you deal with earnings, okay, when you deal with earnings, you're going to deal with a gapping situation. And you don't know if it's going to gap down, gap out. You don't know if it's going to be a breakaway gap, runaway gap, exhaustion gap, comma gap, catastrophic gap. You don't know what type of gap it is. And if I start talking about gaps, I'm going to feel like Bubba Gum Shrimp talking about shrimp because that's the type of what I feel when I talk about gaps. You don't know where the gap is going to do. What we like to do on earnings is we know there's going to be a gap situation. Okay. Thank you, Fibs. We know there's going to be a gap situation here. What we don't know is what that next pattern's going to be because we trade patterns as swing traders. Very, very aggressively, we trade patterns. If we don't have a pattern, we can't determine probability. We don't like to trade. And so, what a secondary pattern is it's the immediate pattern that develops after an earnings gap. And in this situation, the gap filled and formed up a bullish retracement, bull flag, bullish retracement, but that's what a secondary pattern is. And so a lot of times when you're waiting on like post earnings analysis, you'll hear me say, I'm waiting on a secondary pattern, or we need to wait on a secondary pattern. That's just my language of saying we have to wait for the volatility of the gap to smooth out and give us a probable edge. And so when you get the gap here, you gap up, you fill the gap in a retracement coming back down to the 9 EMA. And when you're talking about this pullback here, I love the candle story here, by the way. Gap fill candle, big candle, narrower candle, smaller candle, upward movement in price with confirmation. That's a very compelling pivot story here because remember, it takes three candles to form up a pivot. No, I'm on my Thinkorswim slide. Are you guys, am I not showing? Can you guys not see my toss? Oh my goodness. Hold on. Hold on. Hold on. Let's reshare. I've been off that for a while. Um, let's share the entire screen here. How's that? Okay. Thank you. Thank you. Thank you. Thank you for reminding me. All right. So let's kind of come back here. All right. So here's the secondary pattern. So here's the earnings report right here. Here's the gap on the earnings report. And what I like about this situation here, guys, is you have the candles are telling a very compelling story here. And so you got the gap out on the earnings, and then the pullback immediately starts. Once that pullback immediately starts, you are identifying that 9 EMA on the daily chart. Almost, it's guaranteed going to be the first level that you kind of track, but you want to see this type of dance at that support level. And so support once again is always a creation by the market itself. You have support catalyst, and then you have what is actual the definition of support. A support catalyst is whatever level you identify. The 9 EMA, a previous pivot point, a trend line, a Fibonacci retracement number, however you identify that, that's what we call a catalyst. The actual definition of support is an upward movement in price. And so that upward movement in price is right here. That's what we call confirmation. And so you got, look at the candle story here. It's very compelling. Big candle, smaller, smaller, smallest, doji, upward movement in price, very compelling candlestick formation there. And so you got your pivot candle here, Here's the preceding candle, here's your pivot candle, and here is your confirmation candle. And so when you're looking at that just from a candle story, that looks pretty good. Now, let's talk about how we would think about targeting here. Because again, I don't want to get too stuck on entry and stop loss because believe me, guys, I could, and then we would never even get into targeting. I get lost sometimes when I get way interested in something. So when I'm looking at targeting here, let's assume we're going to enter in above the high of the day, 5% of the ATR above the high of the day. Let's assume we're putting a stop loss, 50%, 25% of the ATR under this little shelf of support right here. I also think you could use the pivot point right there as well. That's dealer's choice. That's kind of stop loss. So we're going above the high and we're getting a stop loss underneath the pattern. Does everybody understand entry and stop loss here? Okay. Now, targeting. Targeting and how many targets do we need to determine whether or not this is a good trade? How many targets do we need? Two. Two. Okay. Now, in any pullback situation, the swing trader is going to target T1 at the first resistance level. We know that's a historical pivot. We know that's been there before. We know that acted as an intraday resistance level. We know it's a daily resistance level. So T1's always going to be the previous pivot point. So that's not always the case on every trade, guys. In a retracement, we target previous pivot for T1. Now, is T1 our real target? Yes or no? Is that what I'm really hoping to get here? Is just T1? No, I wouldn't make the trade if that's the only expectation I had. That's T1 is a management conversation. It's one where you decide, do I want to scale out? Do I want to scale in? Do I like the momentum? Do we want to add to it? Do we want to take it away? That's what T1 is. It's a decision point. T2 for a swing trader is almost guaranteed to get out. Like we're very happy at T2. But T1, more of a decision. Why not enter above yesterday's side? No, 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 no. Woji, that's exactly where you should have entered. You nailed it, brother. Like 100% you nailed it. That's exactly where you should have entered. And do you remember me saying something earlier in the session? I'm already in this trade. I just want to be very clear on this so that I'm already in this trade. And that's exactly what I did. I put it above yesterday's high to get triggered into today. Does that make sense, Woji? Good eye, good call out. That's exactly right. Okay. Question, Morodos. Should you move stop loss after you get to T1? Swing traders want to make a decision every single day. Okay. Not multiple times a day, but we want to make a decision to trust stop loss every single day. Doesn't mean we always do it. But at T1, remember the 6950, we'll just call it 6950 here. At T1, don't worry about that, brother. It was a great question. You had a great call out, and you had a great number that you were looking at, and that's perfect. That was perfect, brother. Like perfect. You nailed it. It was a great question, and it was also an accurate question. So don't ever say sorry for being 100% accurate. You did great. You did great. Morodos, coming back to that question to T1 here. Let's say the market's up over the next three trading sessions, and we get into T1 at this T1 level, you're guaranteed to trust stop loss. Like you're guaranteed to trust stop loss there. But it's really a decision that you have. That you make a decision at that point. And that decision is one of three things. One, do you just close the trade outright? Now, you're most likely not going to do that, but you want to go through the process of making that decision, right? You just want to go through the good process of going through the evaluation. What do I like? Do I like the momentum? Do I not like the momentum at T1? Do I like the candle? Do I like the market? Like there's a lot of things that go into that. Do I like healthcare? Do I like pharmaceutical right now? There's a lot that goes into that, but the most likely scenario is yes, you trust stop loss. That's the most likely scenario. The second thing is, so the first thing is, do you just get out? Most likely not. The second part of that equation is, do you therefore scale out? And what you would do in that number two decision is you would scale out of the position by locking in some gains along the way. That's not a bad thing as a swing trader. You would scale out and simultaneously adjust stop loss. So, option three is to simply adjust stop loss. So, once again, T1 equals a decision. That decision is one of three things: one, get out; two, trail stop; or three, scale. So, do you trail, scale, or sell? That's the question at T1. Once again, let me ask that again. Do you trail, scale, or sell at T1? It's not a guarantee because remember what I said initially just a little while ago. We want to target above that level. Ultimately, we want to see this trend expand. We're targeting the next wave. I want to ride the wave. Does that make sense, guys? Um, I I think you missed your pristine entry here, tipped, but I don't think you missed the entry by going above today's high versus yesterday's high. I just think you got a little bit of additional confirmation. I do think yesterday's high is a little bit better. But also swing traders, I mean honestly guys, swing traders will take full position more than day traders will because a lot of times we're willing to scale out at our T1 and we're not looking to add to that. That would be a little bit different for position traders. Position traders are looking to build into a position over time. They're looking to add to a position over time. Swing traders are pivot to pivot, guys. Like we're looking to get into this pivot and we're looking to sell at the next pivot. You come back to the original conversation here. We're looking to buy at that pivot and we're looking to sell at that pivot. And so when you say full port, I'm thinking full position. And that's like if your full position is 2% of portfolio on a swing trade, yeah, absolutely. By the way, should swing traders ever take more than 4% position size against portfolio? No, no. That number for me is 2%, by the way, on a swing trade. Day trades 1%, swing trades 2%. Position trade for me is max 4%. Once again, I'll write those down because I do think they are important. Day trader equals 1%. Swing trader equals 2%. And that goes to the risk of ruin, by the way. And a position trade is 4%. Oh, RQ makes me laugh every day. I love RQ. RQ, you and me, we're best friends. All right, but does the position size risk world make sense, guys? On the swing versus the day? Okay, good. Good, good, good. All right. Now, the next question, the next question is where's it going to go? So we know our entries above the high. We know our stop loss is under the low using the percentage of the HR that we've discussed. The last question is where's the ultimate target here? Now, ultimate targeting techniques, guys, like there's a lot of different techniques. Truly, there is a lot of different techniques. By the way, one of the reasons why I like the pivot point, it's also an old trend line here. But when I was a young trader, I would target Fibonacci extensions, and that's kind of what I was originally trained on. After I learned potential average yield, I started utilizing potential average yield. And that is primarily the way I target in swing trading, both on the upside or the downside. Now, when you're looking at figuring out your pay, because that's what this entire conversation is about, is figuring out where this thing can go up here. What I want to do is I want to look at the immediate last two that I can find, higher highs, higher lows. And so when I look at it historically here, I look at this point right here to this point right here as a higher high, higher low. That went from 48.90. Somebody help me out with some math. Pull out a calculator if you don't mind. 48.90 to 57.60. 48.90. 48.90 to 57.60 is $8.70. Can anybody confirm that for me, by the way? 48.90 to 57.60. $8.70, right? Okay, so we know the market recently ran, let's say a points a mile. We know the market just recently ran 8.7 miles. Has it proven to me that it can run 10 miles yet? No, it's proven it can run 8.7 miles. That's what it's proven. It's proven it can run 8.7. That's what it's proven. It hasn't proven to do anything other than that. Well, let's go to the next one. Well, the next one's right here. It does include the earnings. It goes from this pivot point right there at 52.75, 52.75 up to the tippity top at 69 and a half. Now, that includes the earnings, so it's going to be a little bit expansion. You'll see kind of how I figure that out here in a second. So 52.75 to 69.50. How much is that? This pivot right here at 52.75 to 69.50 is 16.73. All right. So I know Bridge Bio can run 8.7, and I know it can run 16.7. That's what I know. I know it can run those two. How do I know that? Because that's what it just did. I don't second guess it. That's what it just did. And so to figure out the yield, we take the first level, 8.7, we add it to the second level, 16.73. What's that, Woj? 12.7. And then you divide it. Oh, yeah. So you did it, 12.7. So we got an average of 12.7. And so the average, yeah, I got you. So the average yield here, potential average yield, this stock has proven in its recent two waves to move 8.7 and 16.7. Now, I don't know if it's going to run 8.7 next time. I don't know if it's going to run 16.7 next time. What I do know is I'm going to target the average of those two numbers. And that's what potential average yield is. It's looking at the previous two waves and trying to figure out how far it can run. Now, this one's a little bit off center, and a lot of them in the market right now are. Can anybody tell me why this one moved a lot more aggressively than the last one? Because of earnings, guys. That's why it's off. Is earnings. Earnings is a monkey wrench that throws into the analysis, throws off the analysis a little bit, but the yield still works. We would target 12.7. Now, a common mistake people make here is they take their entry from where they were going to enter above the high of the day. They take their yield from their entry. And so they would say, well, if I'm going to enter at 64.60 and I got a $12.70 potential yield, well, I'm going to take the 64.70 and add that 12.70 and I'm going to target the moon here. That's not what we're analyzing, guys. What we're analyzing is the very low point in a price move to the very top point in a price move. And so you don't take it from where you would be entering, you take it from the low point, and that's, we'll just say $60. So if this thing runs its normal course, it will go from 60, add the 1270 to get into the average yield. The secondary target would be 72. 72. to 70. Now, the last thing that I do to make sure that that is a legitimate target, because guys, most of the work done in a swing trade is done in the prep work of the swing trade. That's where most of the work is done. All of the difficult jobs we have as a swing trader are done in this condition. It's determining where our entry, our stop, and our target goes. That's the most difficult thing as a swing trader is this part of the process. Because as a day trader, you're constantly making decisions. As a swing trader, you're making a decision once a day. Okay. Now, how many of you like that, by the way? That as a swing trader, you just do not have nearly as many decisions to make in the market on a day in, day out basis. I know I do. I know I do. Now, that's exactly right. That's why we call it the set it and forget it, brother. Yes, 100%. Set it and forget it. You did your work before the trade. Think about it. Does any of us have any emotion in this trade right now? Does anybody here have any emotion in the trade? No, no. But when we're in the trade, we're going to have some emotion when we're in the trade. And we're good, and that's where mistakes live, is when we have emotion. A lot of learning how to be a good trader is being a cutthroat trader with no emotion. Oh, it's night and day, Becky. That's why I love the combination of being a day trader and a swing trader is I can do my micro analysis as a day trader while I let my swing trades cook. Like you can't force the time it takes to put on a good swing trade. This trade's going to take because the second part of potential average yield is not just assessing how much price it moves between the low and the high, but assessing how much time it takes to go from the low to the high. And so if I'm looking at that exact same analysis, takes about 2 weeks here, takes about 1 week there, average about 10 days. And so the max you're going to be in this trade is 10 days. You already know it. You can't force that time. Now, maybe news comes out and quickens that journey, but you can't force that time. Um, Chubby Groundhog, I'm sorry, that works on every time frame, brother. Like what you just said works on every time frame. I don't care if you're a long-term investor looking at quarterly charts and making decisions over millions and millions of dollars on the long-term side of the equation, or whether you're scalping on a 1 minute time frame. Probability analysis is always done on charting. And I'm also going to have to disagree with you, brother, as well. And I hate to disagree with my team, but I am going to disagree when you make comments that aren't accurate. Probability analysis is much, much more consistent on longer term analysis than shorter term analysis. I am going to have to disagree with that. Doesn't mean intraday analysis isn't amazing. I love intraday analysis, but we have to be consistent in how we see those things. A longer term chart is much, much, much higher probability of the continuation of that trend than what we're looking at on a 1 minute chart. The most consistent time frame out there is a quarterly chart. The least consistent time frame is a tick chart. Probability wins out as you tie those time frames together. And so intraday analysis, simply because we live on it, does not determine the probability in the same capacity that, say, a daily chart, a weekly chart, or a monthly chart does. That's why it's important for day traders to always understand the context of those bigger trends. And that's one of the biggest mistakes day traders make is they lose the context of those bigger trends. And so and I don't want to get too deep into the woods there, but I do think it's important to make sure that we're all on the same wavelength there. How probability analysis works is it gets more consistent over time, not less time. Just wanted to clarify that. I think we're talking the same language, though. All right. You guys enjoying the lab so far today? Should we do another case study? Let's do another case study. Okay. Um, let's do another pullback, and I'll give you guys a couple choices here. All right. So my gold stocks are not ready yet. They're getting close though. They're getting close. Look at Newmont. Come on, get there. AEM looking pretty good. KGC. Oh man, that's peeking its head right there. I like that one, but they're not ready yet. They're not ready yet. You know what might be ready? Still companies. Look at Still Dynamics here. Breakout, snap back to the breakout channel here. Look at Nucor here. Breakout on earnings, coming back down. A little bit of a retracement, turnaround story looking pretty good. So I like Still Dynamics, like Nucor. 3M a little bit more choppy, a little bit more choppy here, but still pretty good little pullback on 3M. I would suggest. Ford's working a little bit. GM's got that flag. GM's flag got actually confirmed yesterday. Here on Cloudflare, this is something I'm tracking pretty closely right now. I really did like their earnings. This is kind of that pullback analysis after earnings. That needs to be cleaned up. A doji would go a very, very long way. Broadcom, kind of like the pullback in Broadcom as well. Just want to really kind of center on pullbacks. Let's do Still Dynamics here. Okay. So here's what I want you guys to do. Beyond Meat, BYND, and we'll come back to Still Dynamics here in a second. I try not to have too many aggressive opinions on penny stocks. I know a couple traders that made bank on that move from I think Mike was one of them. In fact, I think Mike made quite a bit of money on that move on Beyond Meat. I don't have an opinion on the technical condition of a penny stock, especially the technical condition of a penny stock a few days in front of earnings. So I'll leave that for others out there. Not really my thing. I don't trade penny stocks, to be honest with you. Not that I disagree with it at all. I just don't personally trade penny stocks. And Beyond Meat, I don't. Also have rules in front of earnings. So to ask me my opinion on this would be like, it's not. That's kind of not my thing. That's not true, RQ. That's not true at all. In fact, the opposite of that, I trade the ES because the NQ is a little bit more aggressive than I like oftentimes. But no, no. That is funny though. That is funny though. All right. That was a good question, Nacho. I'd love to have an opinion. If I did, I would have given it to you. But I hope you also understand and respect that when I don't have an opinion, like I hope you respect the fact that I'm not just going to try to make one up here because I don't have an opinion. And if I don't have an opinion, I just don't, right? All right. So let's talk a little bit about Still Dynamics here. Now, before we do the prep work here on Still Dynamics, guys, I just want to talk a little bit about why I like it. Okay. I liked it going into the earnings analysis in general. I kind of was getting on my radar. And the reason it was getting on my radar, guys, is number one, I like the company. I've had some experience with Still Dynamics. It's been on some of my long-term watch list over the years. Hasn't been on my T25 list for about 3 years, but I do like the company, and so I have some history with the company. But more than anything, guys, I like multiple time frame breakouts. What a multiple time frame breakout is when the market is simultaneously breaking out of both a daily resistance level and a weekly or a monthly or whatever the case might be. Can happen on the intraday side too, but the ones I'm talking about are typically when a level is getting breached on both the daily chart as well as that weekly chart. And what you're seeing here on this candle here, look at this breakout. Look at the resistance level at 150. Look at the resistance level at 150. And now you have this good old fashioned trend going into that 150 again. And obviously, you don't want to touch it under 150 because look at the last couple times happened underneath 150. And so I was liking it coming into the earnings right here. I liked this pattern going into it. And then on the actual breakout here, guys, you had the earnings come out, markets breaking out of that level. So you had a positive catalyst on earnings breaking out of a level that has been dominant to that level for pretty much the last 2 to 3 years. Now, market screams up. sets a higher level of resistance right around the 164 level, and then pulls back to the breakout channel. This is obviously known as a bullish retracement situation, and we're looking at a little bit of a pivot formation. Now, I don't love this candle here. Don't get fixated on that candle. It hasn't done anything wrong. I just don't love the candle. The overall analysis is still intact. But I just wanted to talk about why I love it because it broke out on a catalyst. It went up after that, established a higher level of resistance, retraced back down to the breakout channel, and it's trying to pivot right at a known level of support. And so that's why I like it. Now, entry, if you're looking fresh here, guys, entry would either be above an intraday resistance level that you felt comfortable with. For example, I wouldn't be surprised if somebody says, I feel comfortable getting in above that level. Other traders would say, let me get it in above the high. This one's a little bit different here, guys, because the high got triggered on the cash open. I'm not sure how important that high is, honestly. So I would personally use that level to trigger in here above 154.21. Just want to make sure that I'm triggering not above that 9 EMA. Actually, I'm going to adjust. I'm going to trigger above 155. But I would perfectly be fine if somebody said, just let me take the high of the day here. That's always going to be an appropriate thing. Just when I don't love the candle here and I just feel like you can get a better number, I like to put it on the intraday side of the equation and find a level the same way day traders would. I like to find a level I feel comfortable with. I cannot do anything underneath the daily nine. Those are rules for me. Like, do not do anything underneath the daily nine. Make sure you get it above it. Um, so entry, we'll just say above the high. Stop loss here, guys, 150. It would be this pivot point right here at 150 using 25% of the ATR underneath that level. So our entry is going to be somewhere between the 155 and really kind of the 157 level, depending on how aggressive you want to be there. That's a dealer's choice type situation. I'm not sure this stop loss is dealer's choice. 155 is the number, or excuse me, 150 is the number, and it's got to be underneath that level. So 25% of the ATR underneath that level. Now, the question I have for you and the case study I have for you, and I'm going to give you guys 1 minute to figure this out. And the only reason I'm going to give you 1 minute is because we're running out late on time. But I'm going to give you 1 minute to figure it out. Where would you put T1 and where would you put T2? Using what I just taught you, how would you target on still dynamics here for a potential swing trade? Take your time. I want everybody to pull up still dynamics and determine T1 and T2. T1 based on what we talked about, T2 based on yield or pay. Same thing. And then we're going to do it as a team together. Well, is the 50% based on something or it was just random? Because if it's random, not legit. So is T2 based on something besides that? Like what 50% of what though? I guess is my question. Okay. And again, we'll get me the numbers, guys. I'll give you another 30 seconds. Type Y in chat when you got your numbers. Once again, we're trying to determine T1 and T2 from a specific number perspective. Where are you targeting? Swing traders are trained to be market assassins, guys. We're targeting future expectation here. You're good, Becky. Nacho, that's fine. I don't expect a lot of people to be accurate on it yet. That's why it's our first case study. You know what I mean? We're all here just learning how to do it. Everybody's numbers are going to be different, guys, because how you're evaluating the historical performance. What I'm looking at is more about if we're accurate in the zone. I'll give another 20 seconds or so, guys, because it will be different on how you see the previous pattern. Okay, T1. What was the technique in a retracement that swing traders target? They target the previous high, right? Everybody agree? T1 should be the previous high. Does everybody agree with that? Okay, good. So the previous high is 164.73. So if you said anything between 164 and 164.73, you would be accurate. I said personally 164 because I just like to round everything. So who here was close to 164 for T1? Just give me a yes or no in chat. For T1, 164. Where were you, Nacho? 162? Again, T1 in a retracement. You're good, brother. You're good. T1 in a retracement is always going to be the previous pivot point in the move. It's a known level of resistance. It's where it was just barely, muscle memory a little bit. But Nacho doesn't make sense now. It's not important to me that you got your first question correct, Nacho. What's important to me is that you understand it afterwards, right? Because we're all here just to learn more. Remember, when we started this lab, I only had one goal every week to increase the financial IQ of the people that attended the lab. That's my goal. And that's what we're trying to do here. And so this technique took me a little bit of time to get to. So don't worry about that. Again, it's more important that we understand the technique. Okay. We're targeting 164 for T1. Now, T2 is the more is really the conversation piece here. Now, there is a little bit of subjectiveness here, to be perfectly blunt with you. There is a little bit of subjectiveness here. First and foremost, it depends on where you see the historical pivot points here. And so this one is a little bit complicated, to be perfectly honest with you. How I see them, and again, this is where the subjective analysis comes from. I try to see it from the low point in a wave to the high point in the wave. Now, I see the low point in this current wave right here at right here at the 130, 135 level. And so the first wave, I always like to think about pay one, pay two. Pay one goes from 135 up to 149. That's that move. And then it goes, so it's this base of consolidation to this base of consolidation. This is the move inside. And so you got right there, you got 135 up to 149. That's a 14-point move. So we know it can move 14 points before it gets a little bit tired. The second move goes from the low of this base right here to the tippity top of the move after earnings. And that moves from 141 up to, I'm going to give it the 164 level just to kind of make it easy. It moves from 141 up to 164, and that moves 23 points. So I know Still Dynamics can move 14 points. I know it can move 23 points. That's what I know. Now, this move is exasperated once again because of what? What is the causation of the overextension? It's earnings. That throws it off. That's why we average them. Okay. It's earnings. It throws it off a little bit, but I just want to make sure that we're all crystal clear on why both case studies had expansion in their wave count versus what we're seeing in typical situations. But We got to take that into account because price doesn't care. Price is price. And so the first move moves 14 points, the second move moves 23 points. Now, I don't want to target 23 points here, guys. Why do I not want to target 23? Because it took 23 points and a ridiculously positive earnings to get 23 points. I don't know if we're going to get that same degree of momentum here. That's top shelf. 23 points is top shelf. Well, I know it can move 14 to 23. 14 plus 23 equals 37. 37 divided by 2 equals 18 and a half, which means we have a potential average yield of 18.5 points. So if I'm targeting again from the low point to the high point in a move, you go from the 150 point of support right here, you add your yield to it, and that equates to a target of 168.50. Secondary target is 168.50. We are targeting 164 by 168.50. That's the targeting mechanism. Now, does that make sense now that you see me kind of draw it? Derek, that is a wonderful question. Does it add to the data to get more data? As an analytical person, I would say the answer to that question would be an undeniable yes. However, in potential average yield, what I have found is it actually hurts the data if you go and get more. Trends don't last forever. You typically, in a standardized trend, don't have more than two or three expansions before you see some degree of contraction. But yeah, I mean, I don't think it would be a bad thing. And I usually, just off the top of my head, I usually do look at other things than just the two. But I think sometimes I honestly find myself using one move more than three moves, to be blunt with you. Sometimes you only have one move, to be honest with you. It's been neutral forever, and now it's bullish, and this is a trending technique. So it's hard to take anything inside neutrality as that. So I would say one to two moves is what you're typically trying to get. If you want to get more data, get three, but anything over that, I think is overkill a little bit. On the daily, oh man, again, a little bit art versus science here, but I try to go back in time to the beginning of the trend. And this trend really kind of began back here. Like right here is where the kind of the birth point, the epicenter of the trend is. Ultimately, it wasn't a trend until it broke out of that level right there and started establishing new highs. But I wouldn't go back and use any of this. And one of the reasons I want it is that's all kind of inside some degree of neutrality. And neutral ranges are not the same as like you have ranges obviously in neutrality that you would expect the next range to be similar, but potential average yield is more of a trending tool, I would say. Woji, for T1, do you target the very tippity top of the previous hour, come out a little bit lower? I came a little bit lower. Okay. I think that's a little bit subjective, but when you're looking at, say, this high right here, like I, I got that exact same question 3 days ago, Audrey, from another student of mine. And this is how I answered it. You're never going to be wrong targeting the wick high. Like that's not an inaccurate way to do it. Like you're never wrong there. But you're also not trying to capture the ultimate conclusion of the wick high either. And a lot of times I'll come off that a little bit, like I came off that a little bit, and I said 164. Now, why did I say 164? I just said 164 because it was the closest significant whole number and it made the math easy. And that's important to me because I'm not the best at math. And so I just came off that a little bit, but you're never going to be wrong targeting the ultimate conclusion of it. Because again, we're just like T1's making a decision there, right? And as you get into 164, I kind of feel like it's time to start making the decision. And so I said 164, I came off it a little bit. I don't think you're wrong to target the exact high. Um, and if you want to try to remove the subjective elements of technical analysis, use the wick high, but I won't criticize anybody for using the wick high or coming off that a little bit because when you're talking about intraday analysis, like a lot of times we're talking finite numbers. Like you get above 68.02, there's your trigger, right? In swing trading, and the longer the time frames go, the zones are bigger. Okay. It's like support is bigger, resistance is bigger, meaning the zones are wider. And so on the daily chart, whether you say 164.73 or you say 164, the ATR on the daily chart right now, oh, I don't have the ATR up, but I promise you it's more than 75 cents. Oh, great questions. Great questions. Love those questions. But the point is on the daily chart, like when you say that finite number, 164.73, or like I said at 164, like give it a number, certainly. But it's a zone around that number, especially for swing traders and position traders. Because like I said, like you probably have this zone go from the body here to the top there. That would be the legitimate target. So anywhere from 163.50 up to 164.73. But I just don't think you're ever going to be wrong if you say, nope, I'm going from the low point to the top point, and that's what I'm always going to use because that would make you extremely consistent. And I'm not going to be critical of consistency and application in trading. In fact, I think that's one of the most important things we have to get. It's big right now. Yeah, Moji, it is big right now because of the earnings. That throws everything off too. By the way, this is also why swing traders love to get away from earnings season and they don't do a lot of trading inside earnings season. Like that's why I'm getting more excited to do more swing trading here is because we're kind of leaving earnings season. Earnings season kind of shuts that down a little bit because earnings are volatility events, not pure technical events. But that is all we had for the lab here today. Did you guys enjoy the lab today? We went a little bit over time. I apologize for that. Thank you, Nacho. As always, did we again, the only goal I have every single lab, guys, is to increase financial IQ, to get better on our technical concepts that we can apply as traders. And did we achieve our goal here today? Thank you, Becky. Thank you, OG. You guys are the best. All right, team. Well, I hope you guys have a wonderful, wonderful, wonderful rest of your day. And if you need anything from myself, Coach Matt, hit me up in Discord. Outside of that, we'll check you guys tomorrow. Thanks, team.